You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again for the Advisor's Option, the program here on the network for you, the busy financial advisor, asset manager. We get it. You're very busy dealing with your clients. At least you should be right now. These are pretty crazy times in the market. You don't have time really to pay attention, maybe keep up with the latest trends in the world of options, certainly to learn about options trading and education and strategy. Don't worry. We got you covered here on the Advisor's Option. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the ever-engaging, at least we tend to think so, Options Insider Radio Network. And, of course, if the network is not enough for you, that nearly dozen programs, not enough to satiate your hunger for engagement, unusual activity, education about options, all that fun, and a whole bunch more, of course, carving it up by different product categories as well. Crypto options, futures options, volatility, you name it. We got it here on the network for you. If that's not enough, you need more in your lives. And who can blame you, including for a lot of you asset managers and advisors out there. You have questions about these markets. I get it. Luckily for you, we have our pro Q&A sessions as well as options oddities every week, live streams, giveaways, all sorts of fun. It's up there at theoptionsinsider.com/pro is the place to go to sign up and get access to all those great pro Q&A sessions. There's nearly 200 episodes on that exclusive feed for you already. So chances are your question has already been answered up there by some of the best minds in the world of options and derivatives. But if you have more questions, we know you all do. That's the place to go, theoptionsinsider.com/pro. As we go around the horn, see who's joining me on the old Advisor's Option this month. I am once again pleased to be joined by my old friend and compatriot, someone who I have seen in person since the last episode, which is always fun, Mr. Matt Amberson, the founder over there at ORATS. We call him around here the Oracle of New Hampshire. Mr. Matt, welcome back to New Hampshire for you from Florida, where I saw you. And, of course, welcome back to the Advisor's Option, sir.
A beautiful venue down in Florida, Mark. It's great to see you. Getting back into the swing. BOCA, they canceled one, and last year wasn't that big, but this was a sellout this year. So there's a lot of people around. Great weather, great venue, and really nice to see you. Ton going on out there. Wow. I've been getting calls from media outlets. No one near as powerful as the Insider Radio.
Nothing even close to as prestigious as this. Yeah. I know, but sometimes you have to slum it, Matt. I get it.
But asking me about banks, zero DTE, rates, valuations of the market, the CPI implied moves, and gosh, it's been a fun market, Mark. Where options are alive and the market's alive, and what else could you hope for being in the markets these days?
All that you can hope for is another episode of the Advisor's Option. Luckily for you, we got one for you. So let's get to it with the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everyone, welcome to the P&L statement, the segment that was born out of the depth, the darkness of the pandemic, because it seemed like something crazy was happening just about every week, let alone every month in the markets, and we had to parse it on the show, so that became its own segment now encapsulated in the P&L statement. Matt, as you mentioned, a lot's been popping off in the market since our last show. I don't think either of us had a bank run in our cards since the last episode, but that's where we find ourselves these days. What's been lighting up your tape and catching your eye in the markets, options, volatility, all that fun since our last episode, sir?
So when you're looking at the markets, it's difficult to know where to start. Everyone's looking at the Fed, and then all of a sudden this banks deal comes up, and it felt contrived to me. Like I read, pretty deep into it. It almost seemed like they were going after certain Silicon Valley financial institutions for a reason almost. And, so that felt weird. And the rates and CPI. So we were doing we do implied moves in the market, and there was a big CPI number coming out. Powell was talking, and actually the implied moves weren't as big as you would think. So, it's been interesting out there. And as a matter of fact, currently our volatility related signals are actually bullish. It feels so bearish out there. I mean, it just feels like, you have these bank risk, you have CPI, the Fed, really doesn't know what to do. But if you just look at and also the Fed balance sheet, they've been doing the things that you need to do to fight inflation, raising interest rates, bringing down their balance sheet, and with the banks, they just popped it up. Almost they lost 2/3 of all the work that they did on their balance sheet. And, that's bullish for the market. Our indicators, we look at just the direction of volatility. It's been coming down over the last month. The direction of contango, it's back, where you would normally see it, with the front months lower than the back months. And we do this forward volatility relationship that measures the duress in the market, and that's actually coming up to bullish territory. So, we're short-term bullish. I'm still, bearish on the market with the numbers. We've talked about before. You just look at earnings for the S&P companies. We started about $244 per share, and then I think that's going down toward, I made the call 5 months ago on the show that would be coming down towards, with all these interest rate cuts and such, around 200, which is pretty, that's a big move, but it's halfway there already. So, and we're at 18 and a half something PE out there. And if you take the inverse of that, that's an implied equity rate of 5.5%. Well, you could get 4 something in risk-free. T-bonds. So, there's not much, they're not paying enough, I don't think, to people to own this risky levels of the market. So I'm pretty bearish on the market, but, my indicators are bullish. If you look at the implied interest rates out there for the Fed, it looks like there might be a cut out there. I'm not as dovish as that. I think they'll try to stick to a hawkish and still try to raise rates because there's a lot of inflation out there. But they're also, you kind of raise things until you break things. If we see a stop of interest rates or even because people will assume that the Fed knows something about a hard landing or something happening in the economy, and usually that's when the market gets hit pretty hard. So I'm still pretty bearish. I think eventually this market will I've said 3,000 before 5,000. I think if the Fed sticks to its hawkish rate, earnings I think are going to come down in this next earnings season we have coming up. I think July earnings season will be even worse on the guidance, and we'll get it down to somewhere around 200. And a typical PE ratio when you're in a recession, which I think will probably be by July, about 15. So 15 times 200 is 3,000 on that SPX. So I think we got a ways to go. It's going to be an interesting ride getting there. It's tough right now from a strategic standpoint, but we could probably talk about that later. So that's how I'm feeling about the market right now, Mark.
Interesting. You're overall bearish. Your indicator is a little bit short-term bullish. So you can see how people out there are confused and are wondering where to go these days. These markets very crazy out there as we keep on rolling. Speaking of crazy, listeners, we just came off the heels of another wild earnings season. So let's get to it right now. A little bit of the old earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everyone, welcome to the Earnings Volatility Report, the portion of the show where we break down exactly what it says in the title there. We look at the past cycle, see what's happened from an overall single name earnings volatility perspective. What were names pricing in? What did the market expect? How did things actually turn out? And luckily for you, because we like you folks, over there at theoptionsinsider.com, we have a bunch of great reports, hand-generated, well, not hand, but done by Otto's hand. Otto, the great AI over there at ORATS, but of course done by the great team over there at ORATS. We have the earnings season, earnings trade, earning move, and earnings move results reports. So you folks can check out whenever you want, completely for free over there at theoptionsinsider.com. Click on the Options News and Articles tab to get access to all of that great data so you can see exactly what we're talking about right now. And Matt, I know you were predicting, a lot of people were predicting just an apocalyptic earnings season this time around. We saw an interesting one. I don't know if it quite qualified as apocalyptic, at least not quite yet. We did see some earnings outperformance. The last numbers I was looking at, I'm sure you have some more updated numbers. The last ones I was looking at were somewhere around 102%, I believe, and our long-term average is around 92%. So that would still qualify as outperformance, but perhaps not quite as abysmal as we were thinking here, Matt, coming into the start of the year. What are your thoughts looking back at this first season for the year? Was it as bad as you thought? And then what were some of the takeaways you've got in your back pocket for next cycle, sir?
Yeah, great questions. And, just to review what we do is, so we come out with earnings reports with all the individual names, and we have this method for looking at the straddle, isolating the straddle that applies to the earnings day alone. And that's the earnings move. And then we look at past earnings move, and we look at the actual move. And then we put it all into a earnings season report where we show, was the actual greater than the implied? And usually, as you said, it's not. It's only usually about 90, 95. And, but this earnings season, and I think the next earnings seasons coming up, are going to be a lot more important. Was this as big as I thought? No. I thought it would be bigger. I thought, the way I think that people were positioned going in were very bearish. And, earnings, while they were bad, they weren't as bad as they could have been. So we didn't get the big movement. Again, I think this next earnings season is going to be, big again, larger than, the 95 average, I think it's going to be greater than 102. So what that means is, straddle owners, people that think the options or the stock is going to move more than implied are going to be paid for that. And usually that occurs when the expectations of earnings are much different from what actually happens, usually on the downside. So I think that's the way it's going to go this next upcoming earnings. This is going to be more important, as I think, now what we're seeing is it takes a while for the interest rate rise that the Fed brought upon us to hit the market. And I think we're going to start seeing it in earnings more and more. The home builders felt it, especially the first part, but now it's going to filter down into the economy. So April is going to be pretty tough, and July is going to get the rest. So, so that's the way I kind of look at it now. We've only got a couple of earnings coming out now. It's the dog days for the earnings right now until we start up again in early, maybe the second week of April. We have Lulu and Micron that are coming out actually coming out after the close right about now. We're predicting, or the market is predicting much larger than the past moves based on the straddle price. For example, Lulu is $23.5 straddle versus the past earnings moves converted into the straddle is 19.28. And even Micron is 3.31 versus 2.63. So implied is a lot higher than the past moves. I think that's going to leak over into the next earnings season. So, whereas, people were really paid to own straddles, I think the market's going to react to that, raise the price of the straddle, but I still think it's going to outperform people's expectations. So that's how I'm feeling about earnings now, Mark. Again, you were instrumental in getting us to build these reports, and they're a lot of fun to look at and understand what's going on out there.
Yes, it's all our fault at the end of the day. But yeah, if you're looking for a recession by July, then I think it's fair to say that implies a pretty dire cycle coming up next time. So it should be interesting out there. This little quiet period we have between seasons is always interesting, but intriguing stuff. Again, you can check out all those reports for yourselves. TheOptionsInsider.com, listeners, is the place to go. Click on the Options News and Articles tab, and you can begin your journey. Just prepare yourself. There's a lot of great data there. You'll be sucked down a rabbit hole. Next thing you know, 2 hours have passed. I've been staring at straddles here for the last couple hours. But you know what? It's great stuff. And until, like Matt said, until we twisted his arm into doing it, there really was no readily accessible source for this data out there, which was stunning to me because we had questions about this all the time. It's very important data. And yet, for whatever reason, there was one Goldman study, I think about 20 years ago, 15 years ago, and that was about it. So unless you were going to your brokerage house of choice with a very large account size and saying, hey, I'd like to commission some proprietary research, there really was no way to get access to this data. Now, of course, because we like you and because Matt and his team are so nice, we give it to you folks over there at theoptionsinsider.com. But now it's time to keep the gifts flowing, listeners. Time for a little bit of education here on the show. It's time for Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everyone. Welcome to Options 101, a really key component of this show since the beginning. When we first launched this show, a long time ago, over a decade ago, I believe now, with the folks over there at OIC, we talked to a lot of advisors and said, what do you really want from a show aimed at you? And overwhelmingly, they all said education. So that is a mission we have continued on the show to this day. And today in Options 101, we're maybe taking it up a notch. Maybe this is more of a 201 level. I'll let you decide at the end of the day, because we're not just talking basic buying a call, buying a put, or anything like that. We're going multi-leg, listeners. We're going a little bit bigger. Go big or go home on the show today. Today, we're talking butterflies. It might sound scary. You might be like, what the hell, bugs? What are you talking about? Don't worry. We'll break it all down for you. Let's start with our favorite asset. We've all made or lost fortunes on this name, which is XYZ. Hopefully, you're in the green over there with XYZ and not in the red. If you're in the red, talk to me. I know some people. But XYZ, let's say it's trading around $50 again. You're an advisor. You're looking at some clients' assets. Some of your clients are interested in XYZ, and you want to get some short-term exposure to this, to the upside. You think this is going to be moving to the upside. And this is a very common use case for a lot of traders and advisors out there, is a directional use case for butterflies. There are many ways you could take it. You look at it from a vol perspective and others as well. We're just going to take it more from a directional sense today, and then we'll let the ball roll from there. But right now, you want to get some near-dated exposure to the upside in XYZ. So you look at the options chain, the stock trading at $50. That at-the-money 1-month call is worth about $3 right now, trading about $3. You have a little bit out-of-the-money call, the 55-strike call, trading for $1. And you go even farther out of the money, all the way 10 handles to the 60-strike. That call is trading, in our example, for 25 cents. So that offers you a lot of options, pun intended, on what you can do. You can come in and buy that 50-strike call for $3. And now what does that give you? Well, of course, it gives you the right to participate in pretty much all the upside above $53 effectively. That is your break-even point. You need that stock to close above $53 by expiration so that you could at least make back the money you spent on that call. Everything else is yours to keep. Of course, you could see the pros and the cons of that right away. The pro is that you get all that nice, tasty upside. The downside is it's fairly expensive. You're spending $3 for 1 month worth of exposure of a $50 stock. Keep doing that month after month. That's going to really eat into your portfolio, especially if you don't get that move you're looking for. If XYZ just kind of hangs around the 50 strike or maybe gently drifts up to 51 or 52 or even drops, then you're going to be on the hook for that $3. And that, again, that could add up over time. So you might say, well, I don't really want to shell out all that money, but I still want that exposure. What can I do? Well, now we start getting into the butterfly conversation, listeners. So one thing you could do, now we said the 55 strike call is trading for $1. You can still buy that 50 strike call for $3 and then turn around and sell two, not one, but two of the 55 strike calls against it. And because they are trading for $1, you collect $1 two times, or $2. So now what have you done, listeners? You've bought one call at the 50 strike. You've sold two at the 55 strike. You've reduced your overall net outlay to $1. That's much more palatable than $3. So you've cut your outlay by 2/3 right off the top. Of course, you've been listening to this show for a while. You know the obvious con to this strategy is that you are naked short an extra call above the 55 strike. And if you've been listening to Matt and I on this show for a long time, you know we say, don't go naked short units. It's that way it can lead to ruin, especially if you're newer to options and your clients are a little bit skittish about options or these markets. Definitely not a road you want to go down, because that's effectively just being naked short above that. And we all know what could happen. We've all seen the short squeezes and everything else that have gone on over the last few years. So unlimited risk above the 55 strike, not really something you probably want to do with your client's money. So you reduced your outlay. You got it down to $1, but now you've added unlimited risk to the upside. So you might say, I need to do something against that. What can I do? Well, in our example, that 60 call is trading for 25 cents. You can go out and buy that. So now you bought one call for $3. You've sold two against it for $1 each, a total of $2 you collected. So that knocked you down to $1. And then you spent an extra 25 cents on the 60 strike. So now you've added up all of your net outlay to $1.25. So you still cut your outlay more than in half. And what does buying that extra call do for you at the end, listeners? It protects you against that catastrophic move. Something comes in, all of a sudden there's a short squeeze on XYZ, or they blow the doors off from an earnings perspective, whatever the case may be, and the stock shoots up to 80 by the end of the month. With that 60 call in your back pocket, you're not on the hook for that anymore. So that limits your outlay there, which makes it much more attractive. And now guess what you've done, listeners? You have now just legged into a butterfly effective. That is that spread, that three-legged spread, 1 by 2 by 1, done symmetrically like that every 5 strikes. In this case, you can do it however you want to set it up based on your underlying. We'll get to some ways you can play with that in a second, but that is the traditional symmetrical long butterfly out there, listeners. It's a great strategy if you want to reduce your outlay. You want some exposure to an underlying. You think the movement is only going to be over a short range over that short period of time. And then this strategy is a perfect one for you. In this example, the ideal scenario would be for the underlying to move up to 55, sit there and not do anything else underlying moving to your short strike is the optimal position for this. You're going to have those 55 calls decay away to nothing. You will, of course, lose the 25 cents you spent for the 60 calls, but you also will have that call that you bought on the 50 strike will go out at max value of $5. So that butterfly will now be worth effectively its max value. So that $5 minus the $1.25 you spent for it, you're still pocketing $3.75 on this trade. That's not a bad return on your investment there either. So you can see the attractiveness of the old butterfly. Matt, I went back and looked in the archives before we did this. We haven't talked about butterflies on the show in a long time. In fact, I think it's been since we had a listener question back in 2019. So nigh on 3 years ago that we've even touched on this show. So we are overdue for a chat about butterflies, sir. So let's start there. What are your thoughts about overall straightforward long butterflies like this? You a fan? You like them?
So butterflies are not my favorite strategy. Overall, they just don't backtest that well. The stock has to land at 55, right at a spot in order for you to really get the, a good payoff on it. But they've been a lot more popular. We've been hearing a lot more from our clients as this zero DTE stuff, because people are using, butterflies are very interesting for, SPX, XSP, the SPX divided by 100. Because there's not a big outlay, there's no pin risk. So with XYZ as a stock or an ETF, you're going to have some pin risk, which we've covered before, but it comes to if it closes near a strike, you might get exercised and you might wind up with some stock that you don't really want. So indexes are interesting, especially these zero DTEs. People are playing these butterflies quite a bit more. So we have been seeing those, and I've actually been doing some butterflies as well. One way to do it is if you have a directional bias, you might put on let's just say a long call spread, and then if you don't want to have pattern day trading where you close out the positions that you put on, you could make it a butterfly, take off the risk for yourself, get some premium by selling the 55-60, for example, call spread. So you turn a position into a butterfly that takes any risk off, because all you could do is make on a butterfly. What we found is the important thing to do with a butterfly is your exit. So in this example, stocks at 50, your best case is a 55. So what we're showing in our testing is if it goes near 55, that's a good place to exit. So the $1.25 that you paid for this, might go up $1.65 to $2.10 or something, and that's what your expectation should be probably on an exit. So what we found with butterflies is if you're nimble on your exits, it's a lot, I think a better way to trade that, because what's happening is, you'll kind of get greedy if you don't have a plan going in, and the stock will be getting near 55, and before you know it, it's either past 60 or back down to 50, and your profit needs to be around 55. So those are the things that I like to think about around a butterflies, is have a good plan for exit, set your expectations of what you want to make. I mean, that's still a pretty good return, but you should have it and be ready to go. One of the things that we built into our tools now, and we're releasing soon, is an alert. Like, so if you do have a lot of positions and you set this butterfly up, you could be alerted if the stock is getting near 55, and therefore to take a look for exiting that. So that's how I feel, and that's how I look at the butterfly examples, Mark.
I had a feeling you'd have some thoughts on this topic here, Matt. But you're right. It does seem like butterflies are very interesting. I won't say divisive. They're a subjective strategy. It seems like everyone has their own unique approach to them, how they like to put them on, how they like to take them off, whether it's kind of a legging type strategy you're talking about. And you're right, the exit is where a lot of the rubber meets the road in this strategy. How you take it off. Some people like to take it off piecemeal, as a unit, all different ways. The second it touches the strike, like you're talking about, they like to wait a little bit longer, try to squeeze every last ounce of that juice out of the short strike. There are many different ways you can go about using the butterfly, listeners, including broken wings and all sorts of fun. And you bring up a good point as well, Matt. I think we may need to have a whole show about this in the near future, because the 0 day, what you just brought up, that changes the game entirely. And we haven't really discussed it too much here on this show. So what do you think? Maybe down the road we have a whole 0 day Palooza episode of the Advisor's Option. What do you think, Matt?
Yeah, I think 0 DT is clearly, they're becoming very important out there. 41% of all trading in SPX options is in that 0 DTE. We're developing still a bunch of tools. We have some back testing tools, but we're getting even more into it. If I may just kind of pre-sell some of the things, one of the things, of course, we have 1 minute intraday data that we're setting up back testing on. That should be out summertime for us. We're also looking at time and sales of the 0 DTEs, because we're finding that's moving a lot of the market around. So we're going to be capturing that data on a minute by minute basis and graphing it and then trying to backtest it. And if I may, Mark, just talk about the overall, I think this is a good part to insert the ORATS, just overall philosophy is, our philosophy is backtest, backtest, backtest. We're coming up with a system that's going to run. We're going to try to get to 1 billion backtests and offer the summaries of those out to our clients. So it's going to be exciting. They're running now. So you find a good backtest, and then you could overlay some signals to that. So I mentioned some time and sales signals, but we have a bunch of signals out there, and I think keep it basic. RSIs, moving averages, et cetera. When do you want to get into, like, for example, this butterfly? Why are you positive? Hopefully the momentum's positive, RSI's in the spot where you want it, but we could backtest all of that, and you could also then backtest the exit. Is it an exit based on profit? Is it an exit based on delta? Like I said before, as it gets to the 55, you could say, what's the delta of that spread? But you should have all that tested out. And then what you do is once you have a good backtest, go in, adjust some of the parameters to still make sure the backtest fits, for example, other symbols, other parameters that you might set for DTEs, days to expiration, or deltas. And what you're trying to do is get more confident in running different flavors and trying to find out why this particular backtest works. Once you're confident with it, start paper trading it. If the paper trade is consistent with the backtest, you can start trading it small. That needs to be consistent with what the backtest would predict the strategy would do over time. And then get some good execution tools, including some algos to help you get filled well, and also to alert you and even exit for you when certain criteria are met. So, and then after all that's done, then review your trading, see how it's working, why it's working, did you miss anything, is the backtest still following the trading? So that's the overall ORATS philosophy on these types of things. You could backtest many different strategies over many different time frames with many different signals, and you start to develop a strategy that you could be comfortable with, that matches your investment objectives, and that you could take a lot of the emotion out and not be as frustrated. And we're hoping to build the tools to help you implement those strategies, Mark.
Great stuff, listeners. You can check it out over there at orats.com. You're making a hit with our live listeners. We got Nichols in the live chat. He just says he wants to meet Otto. Can you make that happen, Matt?
Yeah, you mentioned Otto, and Otto does so much. You could see Otto in the YouTube. He makes automatic YouTube videos. He does all the work for us. So yeah, he's a very busy guy. He really keeps the ORATS together.
You have to watch out. That guy's gonna get a little fame go to his head. You have to start having meet and greets with Otto out there. He'll have his own fan base.
AI, they do get pretty conceited.
I guess no one ever watched Terminator: The Rise of the Machines. We all got to keep an eye on that Otto as we keep on rolling right on into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everyone. Welcome to The Buzz, the portion of the show where we break down some of the interesting development, stories, trends, events you may have missed in the world of derivatives since our last episode. We get it. You folks are busy out there. There were some events, including the one I happened to see Matt at in person down there in Florida, which was the FIA BOCA show. That stands for Futures Industry Association. As you might imagine, it's kind of a meeting of the minds. All of the global derivatives market really descends on Florida. I think they're all looking to get out of their local weather as well, especially for the Europeans and a lot of us northern states residents. Getting down to Boca in March is not the worst thing out there. So that was kind of fun. And we were talking at the event, or Matt, you were just talking about 0 day, and that's obviously a big talking point for the industry right now. There was a lot of discussion. In fact, I had a lot of discussion about 0 day down at that event. In fact, I was talking to the folks at the SIBO about it. They made it a big focal point of their briefing this year, because obviously they have SPX. That's where a lot of that paper is going up right now, and trying to discuss some of these assumptions that are permeating out there. I mean, we jokingly refer to them on this network as gamma bombs, but there is this perception that they are risk additive out there. So they've crunched some numbers on these. They were looking at the average holding period, for example, which obviously these are short duration to begin with. By definition, they can only last a day, these trades. But most of these trades are even much shorter. They find they're usually within 2 to 3 hours before they're closed. So the notion that people are putting them on in the morning and then holding them right up till the end of the day, not really happening. Also, they said they were surprised, and this kind of surprised me as well, Matt, some of the data they saw. Maybe you've seen this as well from some of the numbers you're crunching. They said that the trades are oddly symmetrical. In fact, more so than you would see in traditional equity options. Usually there's a bias in one direction. There's more puts trading than calls, or vice versa. But with the 0 day, for whatever reason, they're seeing the calls and the puts trading almost exactly 1-to-1, which is kind of weird, and also opens up some interesting questions as to why, but does make it a little bit less scary from an overall risk perspective. I'm curious, Matt, was that your takeaway as well? A lot of people coming up to you talking about 0 day down at the conference, and any other interesting takeaways from FIA BOCA you want to share with our audience?
Yeah, so this is what I've been saying about 0 DTE, is that this is actually, I think, helpful to market makers and risk managers, because you're going to get people that are trading that are, if they're trading 0 DTEs, they're going to be there. And if the market moves, if they have a huge profit in it, they're going to try to get out with a profit. So they're going to be getting in and getting out, and they're doing calls and puts, and a lot of them are doing spreads. And so, what is it, as a market maker, we love expiration, because you got some edge. There's a lot of trading. You knew what your risk was. If you had a lot of risk, you could get out of it. There's so much trading going on. You're not going to get backed into a corner. Someone else will take it down. So, these people are the gloom and doomers. Who knows? But I think it's actually a very good thing. And my predictions are that they'll eventually get down to 1 hour expirations. And because, a lot of these announcements in the economy are coming out, and we're crunching the numbers to see what the implied move is for the day, but we could find the implied move, at 2:30 for Powell's news conference, for example. So, it was cool to talk 0 DTE. I talked to Ed Tilley for a little bit. He's all smiles because the SPX is doing well. It's good to see him, ex-market maker.
Yes, he liked my Gamma Bombs concept. He wants the T-shirt. He just won't wear it in public, he said.
Yeah. So it's good to see him. Kathy Clay was there. I talked to Mike Exaki for a while of the SIBO. So that was fun. Rob Darko of Rival was down there. Corey Fisher used to trade on the floor. Saw him for a bit. So it's a good way to see a bunch of people. You don't have to travel so much, and there's a lot of people around. People are happy to talk and discuss things, and business is pretty good down there. It's great to see you. and chat and just to see the energy coming back to the industry looks alive and well, Mark. So it was good to see.
Yes, we just neglected the giant gooey ball of cheese this time. Maybe next time, Matt, when we get together in person again, we'll have giant mountains of dripping cheese at our disposal there. But speaking of the industry looking healthy, let's get out to the other big data point that's been really obsessing a lot of people ever since the pandemic came on. It's certainly been a big talking point on this show for the last few years is, can this party of options volume, can it continue? Obviously, it really kicked off in earnest with the pandemic, continued throughout 2021, the meme stock palooza, continued with the banger last year, north of 10 billion contracts, another record year. By way of comparison, listeners, we were at just 3.6 billion contracts not too long ago, listeners. So you're talking about just a tremendous increase that we've seen over the past few years. Again, so the question is, can this continue? What we were just talking about, this 0-day explosion, that is certainly having a bit of a effect on the market out there, really keeping a lot of volume in place, turning SPX from a contract that used to do, if it did 2 million contracts in a day, that was an explosive day. That was a crazy day in the market. Now the ADV is 3 million. I mean, it's just crazy how much paper is going up in some of these near-dated contracts. So we have the numbers in hand for February. Of course, in a couple of days, we'll have them in for March now. We're recording this towards the tail end of March, listeners. So in a few more days, we'll have those as well. But right now, the latest numbers we have are from February. Obviously a short month, but this year it was quite the banger. 887.6 million contracts changing hands in February, up nearly 10%, 9.9% from February of 2022, which we all know wasn't exactly a sleepy period out there. And of course, because every month these days has to be a new record, it is the highest, most active February in the history of the options business. Again, ADV in February, 46.4 million contracts. That's up about 6.2% compared to the year previously. So intriguing stuff. A couple other highlights here. Index options, they were kind of lagging behind. We saw a lot of interest in single names, obviously, in 2021 and 2020 and early 2022. The futures and the indexes and the ETFs really kind of lag behind. And that is starting to change now. We saw index options volume up 45.7% year over year. I wonder why that is. Oh, wait, yeah, the 0-day phenomenon we were just talking about, listeners. It's really just transformed the index options landscape. ETFs also kind of getting sucked along for the ride. That up 12.6% year over year. I don't have the numbers on futures. We'll get to those a little bit later when we talk about all the VIX futures options on shows like Volatility Views, listeners. But Matt, any thoughts? Obviously, the party, such as it is, seems to be continuing thanks in no small part to this 0-day explosion, sir.
Yeah, so this, these total contracts out there, I've always been flabbergasted, but I'm getting with the program here slowly, Mark. It's amazing to see how much volume they could crank through this market. And I think, we're growing at ORATS. There's a lot more people coming in, a lot of people buying data, a lot of people using our tools, a lot of people automating strategies. I think it's, I think that's really adding a lot. Obviously, the 0 DTE, the products are there. And then just all of that interest in the 0 DTE are dragging the other ETFs and individual options. I actually think that the rest of the year is going to be more of a stock picking year. So I think that there are going to be more interest in the individual stocks than we've seen. Obviously we've had a lot of Fed, we've had a lot of kind of general overall market macro issues, but I think that we're going to start seeing some more micro going on, more stock specific trading. And so I think that the individual stocks might be catching up. I think we're going to be in a stock picking type of a market coming up, especially with earnings, how well, we've seen banks that have a good balance sheet. We have seen banks that don't hedge their negative interest rate exposure. And so I think we're going to see a lot more of that. So, this volume just continues to go up and up, Mark. I don't really see an end in sight. if we got less volatility, I guess that might hurt it a little bit, but it doesn't look like any of that's on the upcoming. So that's how I'm feeling about this volume, Mark.
Speaking of never ending, your listener mail is never ending, listener. So let's get to some of it now on the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours, the portion of the show where we tackle all of your many and varied topics. We got a lot of fun to get to here in the time we have remaining. First, let's go out to one of our pro listeners. Don't it be? I just like saying his name that way. I have no idea why. He writes to say, Matt, are your indicators still showing deep pain in the SPX? A recession fears proving right and an SPX of 3,200, or have things brightened a bit with our national banking stress test in real time, which may lead to no more Fed cuts, which may lead to a soft landing? My hopes are that you are more optimistic, but I'm guessing that you are still believing that we are going to retest our lows. So as a quick follow-up for Mark, Matt, Dan, and anybody who wants to listen, is it time to buy and hold banks or step into some long-dated calls? Good quality banks are down huge. Even Schwab seems ridiculously beat up. Small regional banks, Bank of America, JPM, what is the play? Thank you guys for all your help in interpreting these markets. Well, Matt, you obviously touched on some of this at the start of the show. You said 3,000, not even 3,200. So you were a little even more dire than Tony was laying out here. But anything else you want to add for Tony? Wants to know your general outlook and overall your thoughts on some of these beaten up banks, sir.
So a couple things. One is, we talked about it a little bit before, so I've answered some of the questions, but I don't like to trade in things where other people are much smarter and know a lot more. Again, I still feel that the Silicon Valleys that went belly up, that felt really contrived to me. That felt like this, they weren't in that bad a shape. And, it was kind of like an odd bank run. And so I squinted at that one. And then, so I still think there's a lot of weird stuff going on. The Fed is related to these big banks. It seems like they want to have fewer banks out there. If I put my tinfoil hat on, they want to get the CBDCs in there, the central bank digital currencies, and they could probably do that better with fewer banks. So, I just like little voices in the back of my head just says, look out. I don't want to play in that field right there. I don't know it that well. I'd rather stay again with the ORATS philosophy of more backtesting, getting systematic strategies that work in certain time periods with certain signals, certain volatility levels, certain momentum levels, et cetera. That's where I'd rather play. I get there's a lot of news out there and it seems fun to get into it, but I just think it's, I don't really have the edge. I like to trade where I have the edge, where I can use my data. More power to you if you really understand this. But I think it would be hard to understand it better than the insiders in this. So I'd say watch out for that. If you want to have a little bit of entertainment value, make sure it's really, really small portion of your portfolio. But that's how I would play those, Mark.
Speaking of watching out, that leads nicely into our next email, kind of a bit of a downer here from Tom. Tom said, did you see that this advisor from your neck of the woods stole money from dementia patients for, quote, risky options trading? And yes, we did see this, Tom, but he included a link. This comes from our local ABC affiliate here in Chicago. The headline is, Chicago investment advisor charged with stealing $683,000 from clients, including 2 men with dementia. It goes on to say his name, etc., say he's falsely accused of telling clients he would invest their money in publicly traded companies, but instead he set up a shell company that he used the funds for personal use, including rent, and this is the part that is relevant to us, obviously, unauthorized trading in, quote, high-risk options contracts, unquote. He lost or spent all the client's funds. This occurred in 2020 and 2021. The SEC also investigating this, again, as they put it, risky options trading. So a lot to unpack here, Matt. First off, there's the obvious sad thing. This is clearly fraud. They should throw the book at this guy. Taking money from anyone, let alone dementia patients, is terrible. They should throw the book at him. I haven't had a chance to go see what these quote-unquote risky options trades were. I always kind of bristle at that characterization. Maybe they were. Maybe this guy was just swinging for the fences in some crazy near-dated, super high-risk contracts, or maybe he was blasting out on a bunch of high-risk. Maybe he was doing that, but they always tend to conflate these two things, options and risk, and they even quote it that way in the article. So that always makes me a little bit concerned. Are we going back to the bad old days, Matt, where anything option is now high risk and therefore bad?
I don't think so. They caught the guy. So I'm an RIA, registered investment advisor, and you have to do so much. I was already audited. I sat with two auditors in a room for a while. You have to say what you're doing, and they were asking, about back testing and everything. So, I mean, they watch these guys, and if they do anything bad, this is not systematic at all. It's just, and I think that this is pretty rare. They love to do these headlines, but again, I think a lot more people out there now know about options. They know it's not a method of mass destruction, but more often can when treated correctly, can make your payoff pictures much more in line with your investment objectives than just buying stocks. So I think that you don't see as many of these types of stories because people kind of get it and they're not out there. There's not a lot of them. It's terrible when it happens. But again, these are few and far between, Mark.
Yes, they are, thankfully. So, yeah, hopefully they throw the book at this guy. The fact that options get roped into this is just this is fraud at the end of the day. Whatever he used the money for, at the end of the day, it's fraud, and they should throw the book at this guy. Here's another one for you, Matt. This comes from Mead, and then we'll get out of here for this month. Mead wants to know, is Matt Amberson still trading his ratio put spreads on BITO, and is he responsible for the massive open interest on the April 10 puts right now? You have a good point there, Mead. We were just talking about this yesterday, actually, on our crypto rundown program, and we highlight all the interesting trades, the size positions in a bunch of these products, including BITO. And it came up on our radar yesterday that there are quite a few, 88,153 right now, of the April 10 puts open, Matt. Looks like someone blasted away on a ton of them for around a quarter or a week or two ago. So first off, Mead wants to know, are you still trading BITO, including ratio put spreads? I forgot. Were you doing ratio puts or just selling the puts? I forgot. And then he wants to know, is that you, 88,000 on the April 10 puts?
I could tell you it's not me. I'm not Mr. Size guy, but I do like BITO a lot. My kids are now gainfully employed, and the investment strategy that I think that for a long-term young person is more of this permanent portfolio where you put I modify it, but it's 25% cash, 25% gold, 25% stocks, 25% bonds. I modify it and put 10% crypto. So when they get paid, they could do it with ETFs. I know, the purists won't do it through ETFs, but BITO sure nice to have an easy way to get in there. And as we look before, the correlation is pretty good with the underlying Bitcoin anyway. So I do, I own Bitcoin, and I do more of a collar strategy. So it's been great because the skew has been decent, and as it goes down, my puts kick in as it goes up. My calls, they don't tend to get called away, and if it really goes up, I still have the underlying. So and I do have some. I don't totally go naked on the calls. So I buy some way out of the money. They're pretty cheap. So that's more my strategy with BITO. If you own Bitcoin and you want to protect some of that downside, and in my case, bought more at 16.5. You have those puts, and then as it gets going down there, you could buy more Bitcoin. So that's my strategy, Mark.
Great stuff. Thanks to everyone who sent in those questions, depressing and otherwise. That music's going to do it for us here on the Advisors Option this week. But you know what? If you need a little bit more Matt in your life, a little birdie told me he's going to be joining me. If you're on the pro side, you can join us on Options Oddities. Matt will be joining me to discuss the week's worth of unusual activity this Friday, Matt. Are you excited, sir?
Yeah, that's a lot of fun. That's where we found Oatly before.
Yes.
And
we learned so far. We've lured you to the dark side of BITO and Oatly.
Yeah, so
50-50 on those, I think. I don't know.
Yeah, no, I really enjoy that show. So I'm looking forward to getting in there and making some money more.
In the meantime, if folks want to get to know Otto and all the other cool stuff you got cooking, where should they go? What should they do?
Yeah, ORATS.com. Like I said, it's amazing what we're doing down in Miami. In addition to BOCA, the whole ORATS team and Otto, AI Otto got together and we mapped out our overall plan. It's going to be great. A lot of backtesting, a lot of systematic strategies, a lot more signals. Just and the tools are really slick. So great. We have a great crew at ORATS. You can reach out to me directly, Matt at ORATS. Try out the dashboard. The scanning's awesome. The signal builder is really cool. You could watch how the market's going. And with BITO, I just went in and saw exactly where that 10 put is trading a penny at 4 cents. It went out. So great tools, user friendly, and a lot of really good data for the programmers out there. So ORATS.com, Mark, thanks.
There you go. Check it out, ORATS.com. You too can get to know Otto and all the other fun cooking over there. Speaking of fun, you want to check out all the educational content they have for you, including a lot for you advisors. It's over there for the OIC. Optionseducation.org is the place to go to kick the tires and light the fires over there. That's going to do it for us on the network today. Back again tomorrow. Double dose of education. Options Bootcamp Palooza tomorrow with special guest, our buddy Mr. Overby, joining us on that show as well. So that should be a heck of a lot of fun. All you pro folks will get it in your ear holes live tomorrow. The rest of you when it hits the network. And then, of course, This Week in Futures Options and the Option Block on Thursday. Friday, Volatility Views. And, of course, Options Oddities with some guy named Matt on Friday. And then back again next week with all of our usual rash of content. And then back again very soon, another episode of the Advisor's Option. Stay safe out there, everybody.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.